stars. This is Professor Don Bush. I've been a professor for about 30 years, a CPA for about that long, and I've got great ways to explain accounting. And let's get to it. Today's lesson is an introductory accounting lesson. It's a lesson that you might see your very first or second week of Principles of Accounting, Introductory Accounting. So we are just starting out. What I've got for you today, I've got a whole bunch of transactions for Fred's snowblower service. And down below here, I've got a general ledger, and the general ledger is the key to the accounting system. It's the heart of the accounting system. It's where it all comes together. And finally, I've got down here, I've got financial statements that we'll fill in. So that's our job here today. So let's get rolling. So what I'm going to do is split the screen so you can see what is going on. All right, everybody, I've got the screen all split and set. I've got the transactions on the top part of the screen, and I've got the general ledger in the bottom part. So all we're going to do is take these transactions and we're going to post them into the general ledger. All right, and this general ledger, it's set up as the accounting equation. Assets equals liabilities plus equity. There's your accounting equation. It's the most important equation in all of accounting and finance. Most everything, I think everything can be derived from this one equation. So here we go, folks. Transaction number one, Fred deposited $5,000 of his personal savings and bank as his primary business account. Now this is Fred's first month of doing business. He's brand new at this, and he's taking $5,000 of his own money. Maybe it's money he had in a jar buried in his backyard or under his mattress or someplace, and he's setting up a bank account, and it's going to be his business bank account. So he's putting $5,000 into that bank account. So let's put it there, $5,000. Now the whole objective of this accounting is to keep the left side balanced with the right side. If we can do that, we can do accounting. So let's see how this is going to work out. Fred considered the $5,000 deposit to be an investment in his business and received $5,000 worth of Fred's snowblower service common stock. So let's put $5,000 under common stock. So taking care of the mechanics here, we've got $5,000 on the left-hand side, $5,000 on the right-hand side. So our accounting equation balances. The left side equals the right. Accountants would say the debits equal the credits. That's all what debits equal credits means. The left equals the right. Now, getting into a little bit more detail, this common stock signifies Fred's ownership interest in the business. Here we go, down to transaction number two. Fred rented a shop, paid the landlord $1,000. So cash is being spent for $1,000, and we will call that rent expense. So check this out. Since Fred is spending money, that's a negative $1,000 out of his cash account. Since we have a negative $1,000 on the left, we've got to have a negative $1,000 on the right. So we got to keep it in balance, folks. Rent expense, negative $1,000. So we are still in balance. So far, so good. Coming down to transaction number three, Fred purchased $1,500 snowblower repair parts with cash to have on hand when customers want snowblowers to be repaired. These parts are considered to be parts inventory. So what's going on? Fred is spending money, spending $1,500. Let's take care of that. There's a negative $1,500. But what he's doing, he's buying inventory. He's buying inventory. And inventory is a nice thing to have. So we're going to put it right here. So look at this, folks. This is really important. If you understand this, you will make a lot of progress here in accounting. So he's spending $1,500 and he's buying inventory parts. So on the left-hand side, we've got a negative $1,500 and a positive $1,500, right? So negative $1,500, positive $1,500, what does that equal? If you combine them together, it equals 0, right? So we essentially have 0 on the left. We've got 0 on the right. So we still stay in balance. Isn't that cool? So negative $1,500, positive $1,500, they net out to 0. So we're good. We're good. If you were to add up all the numbers on the left-hand side, add up on all the numbers on the right-hand side, you would see it still equals. So number 4, Fred signed a contract with a snowblower distributor to sell snowblowers. Fred purchased 4 snowblowers for a total price of $4,000. These snowblowers are considered to be merchandise inventory. Fred did not pay cash, but rather the snowblowers were purchased on account. So in other words, Fred owes this money. Now, Fred, when anybody owes money, that's called a liability. And in Fred's case here, this will be accounts payable. So let's see what we have here. Accounts payable, $4,000. Now Fred is buying more inventory, and inventory is a nice thing to have. So we need the left-hand side equal the right-hand side. I've got something on the right-hand side, but I don't have anything on the left-hand side. Let's see what we can do. Merchandise inventory, $4,000. Let's put that right there because Fred has $4,000 worth of snowblowers. $4,000 on the left, $4,000 on the right. All is good. The left equals the right. We are doing really well. Okay. Number 5. Fred made a payment to the snowblower distributor of $250 cash in regard to the 4 snowblowers. Fred will be making monthly payments until the 4 snowblowers are completely paid for. So Fred is paying paying $250. So he's got a negative $250 on the left. We need a negative $250 on the right. Now Fred is paying down some of the debt. Here we go. Look at that. Negative 250, negative 250. We all balance. It's all good. Now, number 6, Fred signed a contract with the city of Breckenridge. Breckenridge is in Colorado, a beautiful ski town, to do basic snowblower maintenance during the winter season. The contract is for $20,000, and so far, Fred has not completed any work for the city, and the city has not paid Fred any money. Now, Fred has landed a fantastic deal. I mean, this is great for his first month in business, and it'll keep Fred busy during the winter months, and he'll be able to earn $20,000. But so far, no money has changed hands, and no work has been done. So we are not going to record anything because essentially nothing's really happened except for signing the contract. So there we are. So we'll skip that one. Number 7, Fred spent $2,000 to have a business website created and get social media accounts set up. Fred considers this to be marketing expense. So Fred is spending more money. There we go, $2,000. And we have a negative $2,000 on the left. We need a negative $2,000 on the right. And here is just the spot to put it, marketing expense. There it is, negative $2,000, negative $2,000. We are still in balance. Now, number 8, Fred paid wages to assistant Sally, $3,000. So Sally likes being paid in cash, so Fred is spending cash. And this is the cost of doing business. So it's an expense. That's what expenses are. Expenses are the cost of doing your job. And paying wages, marketing, rent, those are all costs of doing the job. Number 9, Fred and Sally repaired snowblowers, chainsaws, and weed whackers, earning a total of $15,000. All customers paid with cash, so a lot of money is coming in. Thank goodness. Okay, there's $15,000. Now, whenever you do your work and you get paid, you can claim that as revenue. So let's find revenue. Here it is, repair revenue. And that's an important thing, folks. Never, ever, ever claim revenue until you've done your work. And Fred and Sally have done their work. Number 10. In order to complete the repairs, Fred had to purchase with cash repair parts costing a total of $4,000. Since these parts were consumed, the parts are considered parts expense. So Fred paid all this out with cash, $4,000. And this is going to be parts expense. Here we go. Now, you might be wondering, what's the difference between parts expense and parts inventory? What's the difference here? Because over here, we, did something funny here. We put it on the asset side, and over here, we're over on the right-hand side. So what's the difference? Well, here's the difference. When Fred bought the parts inventory, these parts inventory have not been consumed yet. They will be in the wintertime when things get busy with snowblowers, but these parts have not been consumed. They are sitting on a shelf, probably collecting some dust, And but it's an asset. It's a nice thing to have if you have a snowblower service. It's good to have parts inventory. Now the parts expense, these parts were used up. They're gone. They're used up. They're part of the cost of getting the job done. So so we put it over here in parts expense. Now someday, one of these days, probably this coming winter, the parts inventory will become parts expense once they get consumed. All right. So number 11. Number 11, Fred had to purchase a drill press, grinder, and air compressor for the shop for a total cost of $3,500. These tools are considered to be equipment. All right, so this is a nice thing to have. So here's equipment, $3,500. So I've got $3,500 on the left, but I need something on the right here. The tools were not purchased with cash, but were purchased on account from Home Depot. So Fred owes Home Depot. Whenever you owe money, that's a liability, right? So accounts payable, $3,500. So I've got $3,500 on the right. If you go down here to equipment, we got $3,500 on the left. So we are good. It all balances out. Fred withdrew $100 from the business cash account, called the withdrawal a dividend, and Fred and Sally celebrated the first month in business by buying pizza and beer. So money's coming out of the cash account. So here we go. Here's our cash account. So let's minus away 100. Let me show you that is in fact the cash account. There it is. Minus away 100. So I've got a negative 100 on the left. I need a negative 100 on the right. So here at the bottom, we have dividends. Now, dividends are nothing more than the owner withdrawing money out of the business. And for big, giant corporations, they call this dividends. And for Fred, he might even call it a withdrawal. But if it's a corporation, the technical term is dividend. So, guys and gals, what we have done, we have completed all of the transactions. So let's come down here to the bottom. I'm going to split the screen. And way down here at the bottom, here's a big question. This is really important, folks. Double check. Does the left side equal the right side? You got to know that. Does the left side equal the right side? Now, we were very careful when we were doing the transactions. I know I was going quite fast, but the left side, does the left side equal the right side? I think it does. We were careful every time we entered in a transaction. But what you have to do is a double check. You want to add up the left side. Just add up the left side, see what you got. All right, so let's see here, cash. What we can do is we can total this up. Now, this is on Excel, of course, and I hope everybody is doing their homework on Excel, because that way you avoid silly math mistakes. And what I had Excel do is I had Excel add up the cash account for me. All right, I didn't have to use my little calculator or something. And if you use Excel, Excel's going to do a great job for you. So learn how to use it. So the cash account balance is $8,150. That is, if you add up all these transactions, you get $8,150. Accounts payable, I had Excel do the same thing. I had it added up for me, $7,250. So there we go. Now, so what I did is I highlighted all the account balances in blue so they stand out. So what we need to do, and this is really important, folks, can't skip this step, is you need to make sure that the left side equals the right side. So here's your job. You got to add up all the numbers that are highlighted in blue on both sides. Now, I already did it because I wanted to make sure this lesson worked out right and make sure that things were going well. So if you were to add up all the numbers on the left-hand side, all the balances, you would get, here, you would get $17,150. All right, so then you got to add up the right-hand side. And I had Excel do all this so there wouldn't be any silly mistakes. And $17,150. So what that means is we did a good job and we can go on. Now, it doesn't mean that we are totally error-free, but chances are good that we did a really good job. But now, if these two numbers, the left side does not equal the right side, you have to stop and figure out why. Because if you go on, it will not work. Guaranteed, 100%. It won't work. It won't get better. You won't get it right. You just got to stop and figure out where you went wrong in that general ledger. All right. So Here we go. So coming down here, I'm going to split the screen once again. We are now down to the financial statements. So we'll hustle and get this job done here. So the financial statements are pretty easy. So what I have here on the top part of the screen up here, I've got the general ledger, which we're just working on. On the bottom part of the screen, I've got the financial statements. And I've got over here on the left-hand side, I've got the income statement. Now, folks, you have to start out with the income statement. You cannot start out with the other statements. Now, sometimes in your textbook will say something like, complete the transactions and do a balance sheet, income statement, blah, blah, blah. Oftentimes, the textbook will state them in the wrong order. And I don't know why textbooks do that, but almost all textbooks do. And you have to start out with the income statement, period. There's no choice about this, all right? Because the information from the income statement is going to get transferred to the next statement and so on and so forth. So you have to do the income statement first. Repair revenue. So here we go, and all we do is we look at our general ledger and we just pick out the numbers, and there we are. The income statement, the only thing that goes on the income statement are revenue and expenses. That's it. Revenue and expenses. Nothing else goes on the income statement. Revenue and expenses is it. So repair revenue, here it is, 15,000. Let's put it down here, 15,000. There you are. Okay, and let's come down to the expenses now. Rent expense. So coming up here, and let's find, there you are, rent expense. Now I've got a negative 1,000 here, and let's see how I wrote it. I don't remember. Okay, now I know that this is negative 1,000. I've got a positive 1,000. Don't get too worried about that. Everybody knows, who knows anything about income statements, knows that you're going to subtract away the expenses. All right, and so I just, for whatever reason, chose to write it down as a positive number. You can write it down as a negative number if you want. It doesn't matter, but just know we're just going to subtract it, whatever it is. Marketing expense. Got negative 2,000 there. We'll put it right down here. There it is, 2,000. Wages expense, coming down to wages expense. There we are, negative 3,000. I'll just have it here as 3,000. Parts expense. There we are. 4,000, okay. 4,000. Now, total expenses. All we're going to do is add up these expenses. There we go, and 10,000. And folks, if you want to list these as negative numbers, go ahead. It doesn't matter. You can list them as negative numbers. It doesn't matter. All we're going to do is take our repair revenue, and we're going to subtract away our expenses and get our net income. That's all we're doing. So our net income is $5,000. So Fred did fantastic for his first month in business. Repair revenue, that's money coming in from doing your job. Expenses, that's money going out from doing your job. And net income is whatever's left over from doing your job. It's your profit. Like I say, these numbers flow. In fact, I've got these highlighted in nice, beautiful blue. And the reason why is because it reminds me of the Columbia River in Oregon, and the Columbia River only flows one way. It flows from Idaho to the ocean. That's the only direction it flows. It doesn't flow any other direction. And that's how these financial statements work. These numbers flow in one direction. So we're going to take this net income, and it's going to flow over here to net income. There we go. There we are. We'll just put it in there. So here we are. Now we're doing this green statement now. It's called the Statement of Changes in Retained Earnings. And it's a reflection of Fred's net worth in the business is what it is. Now, Fred's just started this business this month. And so his beginning retained earnings is zero. It's zero because he just started the business. But he had a good month. He had a net income. And then what we're going to do is we're going to subtract out dividends. And if you recall, the dividends were $100. So let's put in $100. Now, for whatever reason, I don't know why, I just decided to put it as a negative number. And you might say, well, you're not being very consistent, and maybe I'm not. But the point is that we're going to take the beginning retained earnings, add the net income, subtract out the dividends, And we're going to end up with ending retained earnings. So here we go, ending retained earnings. Let's see here, get the right color of print here. Oh, that is not. Okay, there we are. 4,000. So there's his ending retained earnings. So he went from a zero net worth in this business to 4,900 if we excluding his common stock there. Now, what I've got down here is I've got in this pink box here, and I'm calling it alternative format here. So what is going on is most all textbooks show you how to do this statement of changes in retained earnings like we just did it in this green box. However, there are a few textbooks that show you how to do it like this pink box, and I don't want to get people confused. So here's what's going on. We'll do this green box once again in this pink box, but we'll use this alternative format. Now, I'm not saying that you have to do this twice. You only do it once. You're either going to do it this way in the green box or this way in the pink box. You're not going to do it both ways. So, but I'm showing you how to do it both ways. They're both pretty easy. So here's all we're doing, folks. There's not a lot of difference here. So what we're doing here is in this column right here, this retained earnings column, it's identical to what we did up above. So all we're going to do is take the numbers that we did right up here and transfer them right down here in this column. No different whatsoever. Exactly. So the beginning retained earnings balance was 0. And the next line here is issue common stock, but we're going to skip that for a moment. Add net income. Now the net income is right over here. It flows over just like a river. And here's the net income. Minus out the dividends. And if you recall, the dividends were $100. There we go. And so our ending retained earnings balance is going to be 4,900. And you can see it's exactly the same thing as up above here. The only real difference between the green box and the pink box, or the difference between these two formats, is this column right here, common stock. Well, with common stock, the beginning balance in common stock at the very, very, very beginning of the month was 0. So I'm putting 0. But Fred issued some common stock to himself. Remember, it was the very first transaction, $5,000. And then Fred, okay, we're going to skip net income. We're going to skip the dividends, and we're just going to put the ending balance right there. The reason why we're skipping the net income and the dividends is because we put them in this column over here, retained earnings. Now, this last column is super easy. The total, all we do is add horizontally. So 0 plus 0 is 0. 5,000 plus 0 is 5,000. 0 plus 5,000 is 5,000. And 0, and a negative 100 is a negative 100. And if we add these two numbers up, 5,000 and 4,900, we get 9,000. There we are. Get it? There we are. 9,900. All right. Coming down to the last statement here, the balance sheet. Here we are, the balance sheet. So all we're going to do is take numbers off the general ledger. That's all we have to do. So how much cash do we have at the end of the month? Here's my cash account right there. Here's my cash account. So what do we have at the end of the month? $81.50. So let's put in $81.50. There we go. How about the parts inventory? How much in the parts inventory? Those are the parts sitting around collecting dust for now. They'll be used up in the wintertime. Merchandise inventory. How much do we have for merchandise inventory? We've got 4,000 right there. Let's put on the balance sheet. Equipment. Hey, do you notice that everything about the assets here is coming off the left-hand side of this general ledger? That's not an accident. So the total assets, all you got to do is add this up. Man, use Excel. Here we go. How about accounts payable? Oops, went the wrong way. Accounts payable, folks. So going up here to accounts payable. Now we're handling the right-hand side of the general ledger. Accounts payable, there you are. $7,250. And the grand total is going to be $7,250. There we are. Coming down to the bottom part of this balance sheet, the stockholders' equity, we have common stock. So let's see. There it is, common stock. $5,000. So let's put it right here. And I've got highlighted in blue retained earnings because we can take it off of either this statement, the one that's in the pink box, or the green one, the green box. They're both the same, $4,900. Retained earnings, there we go. Let's get it in the right color. There we are. And so all we do is add this all up here. We get $9,900. That's the total stockholders' equity. Now here's the last part. Don't drop the football on the 2-yard line. You have one step to go and then you're done. We got to add up the total liabilities and stockholders' equity. So here we go. Total liabilities and stockholders' equity. If we add them up, here's what we get. $17,150. And folks, let's make sure it balances. $17,150, $17,150. We have got the job done, folks. So I hope you enjoyed this lesson. Hope it helped you out. If you like to hit that like button and subscribe. And until next time, over and out.